Hello.
Hey, Mike, how are you?
I'm doing good. How are you? Refreshed?
Yeah, yeah. Um, Always good to get out of Dodge and put your toes in the sand and
Wait,
kind
isn't there
of
isn't
chill
there a
out.
song? Isn't there a song about that?
I'm sure there is. Yeah, Jimmy Buffett. Yeah, I'm sure. Yeah, yeah, for sure.
Uh, where'd you get off
Yeah,
to?
we were in Hilton Head.
Oh,
Um,
sweet.
yeah, yeah. So it just didn't have a drop of rain. Temps in the mid 90s. Blue skies. Just hot, perfect beach pool weather. So it was, couldn't ask for anything, better weather for sure.
Perfect. Good to hear. Good to hear. Um, you didn't miss a whole lot. We had a great chat with Kip last week. Always fun to
Yeah,
have Kip.
big shout out to Kip. Thanks for jumping on. That was awesome.
Yeah. So you know what? We've got a pretty good crowd already. Why don't we just jump right into things? There's a lot going on today, kind of around
Yeah,
the
I'm going to
world here.
share my screen here, and we'll just kind of run through it. Glad to be back. I think let me do this. We'll kind of get into the normal stuff. Obviously, a reminder, we continue to have the CME new contract webinars. Today's the final one, and it's going to discuss the creation of rolling the existing contract LBR into the new contract. I'm sorry, the new contract LBR into the existing contract LBS into the new contract LBR. So that's later today. Again, all of these are recorded, so I would highly recommend, if you have not seen every one of these, to go back and watch these. And if you have very specific questions, then reach out to Candace, Allison, Tom Crane. Reach out to the CME specifically, and they will respond to you ASAP. Um, so that's your best bet.
Yeah, I think today's going to be interesting. It's one that I don't really know too much about how that one's going to work either.
Yeah, I think the big question that I have, just in talking to people, is, well, how quickly do I roll my positions? Do I wait? And that's something that we're all going to have to figure out real time, as far as how quickly does a building open interest. And amazingly, what a difference a week makes from open interest standpoint. But we're do you roll an existing position right away? Do you wait? And that's going to be to be determined, where we'll see how this, the inaugural contract trades kicks off, what kind of volume it generates, and how quickly, you know, the crowd, so to speak, is willing to roll their position.
Well, you know what my view on this as a professional trader is that um, once you establish what the spread should be, like the
Yeah,
fair value of the spread, if you can buy the bid and sell the offer, you should do that all day long, right? It's when you reach across the spread that you're giving up some fair value. You're losing to fair value.
yeah.
Um,
And I was told by the CME, as far as determining what that spread should be, they are going to set some kind of preemptive uh, freight delivered to Chicago above and beyond FOB Prince George. They're going to use their best guess initially to kind of set that. So you're not going to start off at like $20 and float out to 70 or 80. They're going to set, based upon random lengths print, um, what they think that freight should be from the get-go. And
but
I'll
can't we
follow
just
up on that.
can't we just find out what the lowest published tariff is? Go from there.
Yeah, I know, and I think all that's kind of going into how they're analyzing it and gonna kind of set that initial determination. And the beauty of a market is the market's gonna figure this out pretty quickly, as far as what that freight should be.
Yeah. So I don't think there's going to be any advantage to really stick around in the old contract for very long.
No, no, and I know a couple of weeks ago we talked about that liquidating open interest structure, and I want to just jump in. We'll come back to all this other stuff, but amazingly, open interest. This is open interest as of a week ago. We were 1878. the expectation was that everybody was getting small in anticipation of the kickoff of the new contract. Fast forward to yesterday's open interest. So we went from 1878 to 2244. Again, you can see you added just over 200 in September. You're adding in November. So when you look at CFTC, give me 1 second. I forgot to add CFTC. Let me pull
Oh, the
this in
commitment
here.
of traders. There we go.
Yeah. So amazingly, I would have to think that this is a new commodity fund now, but the managed money commodity fund shorts increased by 259. If you remember, this traded, I think, sub 400 into that 350 area. So over the last week and a half, we've seen a big build of that commodity fund short position. And as everybody remembers, that back in July, on the move to the upside to 750, the funds got worked out of their short position. Well, on this kind of resumption of the downtrend now, they've been adding to their position. Swap dealers liquidated basically all of their positions. And I would think that this has more to do with just, again, getting small in anticipation of the new contract. You've had light building with commercial longs. You continue to see the commercial short position. The commercial sawmill position is at an extremely low level. So to me, again, this is the main catalyst on this down move, this ongoing move to the downside, where the funds just are continuing to sell from 600 down. We traded down to 514 and change
Yeah,
yesterday.
but just want to point something out, Greg. In that
Yep.
short number is also the hedgers or basis traders.
Yep.
Of which they don't exist right now because
Right.
there hasn't been a basis trade opportunity.
No, the basis is buying futures, not selling futures. So interestingly, when you look at this long position, when you look at this managed money position, 90% of this is in September. It's always front loaded with the commodity funds into the most liquid contract, which is September. When you look at this commercial long position, this is spread out. It's not just September, it's November, it's January. So when you go back along, go back to this, when you go back along this curve, you have commercials buying this entire curve based upon the timing of when, if I'm committing a job for November or January or March, even though this new contract's coming online, it's still business as usual where, all right, I'll worry about rolling when I have to, but I need the coverage now. And as long as you're at this, let me go back, Mike. So here's the basis a week ago in September, about $100. Fast forward to this morning, you're about $109 at the low water mark yesterday. Again, you had September in the 514 and change area. You had print in the, call it a 654-ish type area, 655 area. So futures continues even along, and I know I'm making everybody nauseous here, but even along this price curve where you've got the cost of carry in the back months, even when you look at May at 590, March at 581, January at 561, November at 552, these are still substantial discounts to today's physical cash based upon random length print. So the commercial, again, when you go back to, oh, sorry, I forgot it's not in here. Let me find that. Where's it at? Okay. So when you go back to, when you go back to the CFTC numbers, again, this fund position is all concentrated in September. This position is rolled out along that price curve. It's not all concentrated in September. Look, if I don't need the wood for September delivery, I'm not buying for September. Even though it's the biggest discount, I might be buying November. I might be buying January. And that's where, when you look at, the open interest structure, 1420 a week ago in September, 386 in November, 63 in March. Again, you're seeing this, again, primarily the build in November here along with September. So, long story short, and again, I know we're jumping all over the place with lumber here, but when you look at, here's the weekly continuation chart. We took out this recent low.
Yep.
This is the 530, 517 area on the continuation. I'm sorry, this is 531 on the continuation. Underneath here is the 454-ish type area. So that's the next big downside target. You see it more clearly on the September daily. Bollinger Band lows of 490. So that's kind of the next big downside target in this, the 500 to 480 area. But the second the commodity funds stop selling September here, and we know that based upon, here's the SEPNOV spread as of today. That spread is traded out to negative 23 so far. It's negative 2270 last. That spread continues to widen out. So you're getting kind of the long September roll here. If I go back to this July, September, here's July, September, the middle of June. You traded out to the negative 24, negative 25 area. The funds started to roll their position somewhere around June 10th to the 13th. The second they started to roll their position, that spread went from 25 under. You went back to even money pretty quickly. You went back to a premium. The expectation was to see that move back to 15 to 20 over. We actually went back out to 45 over, but given the open interest structure, the funds aggressively selling September, I play devil's advocate with me, but I don't know why the same thing doesn't happen in September, November, knowing that the commodity fund shorts are heavily concentrated in September. At some point, they're either going to have to liquidate. Okay, they might not liquidate the position, but at the very least, they're going to roll their September shorts into November, and they're going to do it between now into the end of August. So my
And
expectation.
here's a pro tip on that.
Yeah.
Fund managers like to go on vacation in August, so it probably happens sooner than later.
Yeah, no, I think that's a great point, Mike. And, again, this has nothing, as much as fundamentally we're kind of not following the seasonality in the outright where, we typically bottom and grind higher through August into September expiration. We continue to push lower. Just from a pure fund standpoint, the funds are building a short position in September. They have to roll their position into November. Are they going to roll September, the existing contract to the mini first? That we don't know. We'll have to wait and see. But that they're going to roll into November.
Going back to that commitment of traders report, it can be the most boring thing to look at for 4 to 5 months, and then you see something like that just happened, and that's a nugget of gold. Knowing that the funds are short is a nugget of gold right now.
I keep doing this. Let me pull it back up one more time. All right, there it is. No, for me, the funds give stability to markets from a spread trading standpoint.
Correct.
Because and it's clearly, any fund that's publicly traded, they have to put out a prospectus to the public, to their investors, and they'll tell you exactly when they roll positions in a deliverable contract. That we're out last business day of the month preceding expiration, or we have to be out the month, 2 months preceding expiration, the month going into spot month. They all clearly dictate this in their prospectus. And that, okay, this position in September is going to be rolled or liquidated by the end of August because they're not going to be in a delivery month come September 1st.
And, the other thing that I think lumber people may forget, while lumber makes up a component of some commodity funds, it's a very small component of a massive fund. So like you'll see these moves in other commodities. It's the dog's wagging his tail and it comes down to a little bit of lumber. So oil has definitely, we're probably going to look at that, right?
Yeah. And we'll go back to, let's go back to the beginning here. All right, so here we go. So again, when you look at commodities as a whole, obviously crude oil has this stair step higher. You continue to have these one-day events like yesterday where you give big chunks of it back, and the stair step higher is more based upon supply constraint. The big washouts lower or more fear of demand, an impending recession. Equities have done a fantastic job of stabilizing with the
But yeah,
expectation that I'm sorry,
that's
go ahead, Mike.
that's what I was talking about though. If oil's going lower and the
Hmm.
funds are starting to get short oil, when they put money into a fund, if I should say, if investors decide they want to get short commodities because they think oil has run its course, they're going to end up short lumber as well.
Yeah,
And
yeah.
they don't care if they're selling lumber in the hole or, that's why you can sit here and say, oh, why would anybody be selling lumber down here? Well, they don't care because they're selling the fund and it's just part of the equation.
Yeah, no, they want that. Again, it's when you look at commodity funds. All right, we're heavy into agriculture. We're heavy into precious metals. We're heavy into energies, but we want some kind of diversity with our portfolio, our basket of goods. So we're going to look at the sauce. We're going to look at a cotton. We're going to look at cocoa. We're going to look at coffee. We're going to look at some of the other precious metals like palladium, platinum, outside of the obvious ones like silver and gold and copper. You're going to look at lumber. And if you want exposure, I want to be short building or I want to be short building materials. Well, lumber is an obvious thing to get short, and everybody, has to realize that for a commodity fund to take a position of 20,000, 100,000 contracts in crude oil or unleaded gas or precious metals, it's a very easy thing to do. But a maximum position in lumber, which is huge to you and I, is so insignificant. It's probably a 1% allocation of their overall portfolio exposure to have that max position or a 400 or 500 car position in lumber where it barely moves the needle, but at the end of the day it gives them exposure to some other market that, like housing that they want exposure to.
Absolutely.
um,
Yep.
so
Exactly.
the big thing, takeaway for me is that equities have bottomed. We continue to climb, and I think it was Tom Lee on CNBC last week that basically, referenced equities after the FOMC meeting. Basically made the comment, well, equities are equities, the economy is the economy. What does one have to do with the other? And you're probably into this time period now where equities are more fixated on earnings. And when you look at earnings as a whole, you're continuously beating pretty much in all sectors, earnings forecasts. So the market's fixated on a better earnings cycle. And then the other big thing is, you look at, here's the low water mark on the 10-year note. You peaked out at 3.49%. You're back into sub 270 as of today. 30-year, you're back in that 5.41%. So, that in tandem with, so here's S&P again. Here's the low. Depending on what high you want to use, you're back at a 50% retracement off of this high right here, and then 62% off of this high right here would be up in that 42.12 to 42.50 area. So technically speaking, you've come a long way in a short amount of time, where the upside potential in equities would be somewhere in this 42 now to 43.50 area. I've got some Elliott Wave guys that kind of have projected that between now and to the middle of September. So the market seems more fixated, less so on the aggregate underlying fundamentals of our economy, more so on quarterly earnings. And when you look at it's kind of funny when you look at the talking heads on CNBC and Fox Business. Everybody has to remember that when we trade commodities, you don't have a tendency to look at the long side only. You know that you can short commodities, you can short a market like lumber. When you look at equities and buying stock shares, you're conditioned that you buy low, you sell high, you buy something with the idea that it's going to appreciate. And so when you look at all the analysts out there, 95% of these guys are all buy side analysts. Well, what's the buy side analyst job? It's to find value on an asset where you're going to appreciate over time. So for me, when you get into these earnings forecasts, quarterly earnings, magically 2/3 of the time, going back to 2010, somehow all sectors 2/3 of the time beat analyst earnings forecast for earnings per share and sales forecast. Well, we've been conditioned that let's set the bar low. When everybody jumps over the hurdle, life is good. And so that's what you're seeing with this quarterly earnings, where again we magically continue to beat earnings. So I think the reality is, if equities are truly influenced by the economy, then Q3, Q4 set up to become very interesting from an earnings standpoint. We'll see how real, the threat of inflation, ongoing inflation, an economic slowdown, the R word, or recession is, but you're not going to see it show up until Q3, Q4 type earnings. Q2 is a reflection of what was.
So it's something I saw today too. Geopolitically, Nancy Pelosi landed a plane on Taiwan today, and China said, we will be very upset if they do that. I was watching the S&Ps while this happened. As soon as her plane hit the airspace, things were selling off. When nothing happened, it rallied. So
and look, I think
potential bad news, and we blasted out of there.
No, and I think the U.S. Look, I think Biden, as much as we all want to criticize the current administration, he's like, look, this is a U.S. citizen. We don't control our citizens and tell them what to do. They have every right to travel, and I might not agree with it, but they have every right to go to another country, and we recognize Taiwan.
She was riding on a U.S. Air Force plane.
Well, yeah, that's besides the, come on, Mike, that's besides the point.
Let's moving along here. All right.
So the other big thing, commodities, especially gold and copper, have shown signs of a significant bottom now. Wheat is trying to do the same thing. Crude oil is trying to do the same thing. And to me, it's all predicated on US dollar topping out. So as the dollar moves lower, you're more likely to see commodities move higher. If the dollar goes back and retest highs, then you're more likely to see these markets sell off and retest their lows. The laggard here is obviously lumber. And when you look at commodities over the last 5 days, you have silver, you've got platinum, copper, you've got S&P, the Dow, NASDAQ, even lowly Bitcoin, all showing pretty significant gains week over week. The laggards, lumber continues to be at the bottom of the barrel, along with energies and wheat, and kind of these markets are more, especially the grains and energies right now, more fixated on the potential of a recession, more geopolitical events. So it'll be interesting to see, what's good enough for lumber and finding a bottom. And we can, what is this one? Oh, U.S. inflation to stay well above Fed's fund target. Fed, the market basically is saying that the Fed has a target of 4% for inflation. Statistically, the market sees a 95% chance that it stays significantly higher than what they're forecasting. And we can jump through this. The one thing I wanted to point out here, and we'll jump back into lumber because I know we're starting to bump up against time. Disposable income. This is the one that jumped out to me, Mike. When you adjust disposable income for inflation, you can see how we're back to, you had all this free money pumped in, and look at disposable income now, having to factor in inflationary goods. You're almost at a negative level now. You're back to the 2020 type levels right now.
Yeah. Well, but I saw the price of gas is coming down a little bit.
Hey, I paid anecdotally here. I paid in South Carolina sub 350.
Oh wow! I saw $3.99 in Wisconsin.
Yeah, so it was that's pretty good. So when you look at, interest rates, again, back in the 5.41% area, kind of, still toward the high end of interest rates since 2001, but you've definitely pulled back from that high watermark over 6% for the time being. So we'll see if that re-engages any type of buyers on the outside looking in, as far as rates moving back sub 5.5%, if that triggers any type of demand with housing.
Okay.
So just going back into lumber now, implied volatility is still high. Seasonally, I referenced this earlier, we continue to kind of moving away from the 3-year, but from a 5-year standpoint, you're getting into the first week of August on a 5-year standpoint when the market bottoms. So seasonally, you're between the 3-year, the 5-year. You're obviously significantly lower price-wise. So we'll see if that means anything, and we get this upward trend into September expiration. And again, I think for me, the second the funds stop selling this, you saw this a little bit yesterday, where the funds aggressively sold down to new lows in the 514 area. The second they let up off the throttle, the market had a big reactionary rally back sub plus 540, and it didn't take much volume to move back up to those levels. We went over the week.
I mean, we know that there's no industry interest in selling.
Like, no, and
you're not hedging on a basis trade, and theoretically, you can sell your cash at $100 over futures. Just keep selling cash, right?
Yeah. So from a valuation standpoint, is September a better buy or a sell? Well, if you ask a commodity fund, they think it's a sell. But if you ask an industry, person, then, well, the reality is, when you look at, again, from a basis standpoint, I'm selling at a significant discount to where their mills are asking me. I've seen one mill sub 600 so far on 2x4s. The majors still seem to be significantly higher, not looking to really take counters on 2x4s. So this again, here's September, here's November. Again, going back to our forward curve and futures, this still represents the best value from a buy standpoint. Futures is your best buy, cash is still your best sell.
But unfortunately, if you buy futures and you want to roll it, you pay a premium right now to roll that long.
Yeah, no, absolutely. You're going to pay a premium. And my suggestion for those looking to roll, September 20 under November, again, you go back to, let me go back to the spread here. Again, do we mimic what we did in July, September, where, again, if I'm looking to roll my longs, I'm probably waiting to see, once the funds stop selling September and start to roll, I'm probably going to have a better chance to roll my longs at a better spread differential than today.
And just to interpret what you're saying, if you own a contract, to roll it to the next one, you sell it and you buy the next one. Yep. So ideally what you're doing is selling your contract at a price that's higher than you're buying the next month. Currently, we're at a discount around $20. Ideally, you would have a premium. You would sell your September for higher than you're buying your November.
Yeah, and that being said, again, here's the July, September. Again, this same time frame, we're entering this same time frame, and when you compare where we were X number of days out from July expiration to X number of days out with September expiration, you're basically, the beginning of June equates to the beginning of August. So again, the July-September spread was heavily influenced by commodity funds selling. As the funds started to roll their July position into September, and then ultimately started to liquidate their July positions as the market moved higher, this spread went from 25 under, again, somewhere around the 10th to 13th of June. And you could see it went from 25 under, really the meat of the volume was done in the 20 to 30 over area. So, if the expectation is we're going to follow the same kind of pattern because the funds are developing the same kind of pattern, then you would think that this would bottom out between here to 25 to 30 under. You would do it in the next week to week and a half. And then what you're looking for is clear signs of those funds rolling their, starting to roll their September shorts into November. By virtue of doing that, you get the buy paper in September, you get the sell paper in November, and this pushes this spread back out to, realistically an even money. My expectation is you go back out to 13 to 25 over, and you do it pretty quickly. And that would be the time for the long Septembers that don't want to take the wood to roll their position into November at that point.
That's the camp. Yeah, I'm in that camp as well.
The one last thing I wanted to point out was, where's that here? So Statistics Canada came out with their BC exports into the US, and we're still, when you look at year to date for 2022, BC Interior is still down 10%. Total Canadian production is down 7.86%, or shipments, I'm sorry, not production, shipments into the US. And then when you look at, here's 2022 versus 2021, BC Interior is down 9.28%. And then aggregate Canada year over year is still down 3.45%. So again, you continue to take more production out of BC Interior, and then this shifts to Alberta, to the east, everywhere else in Canada, as far as making up that production.
I'm going to bring up a topic I should have warned you about ahead of time, but I never thought about it until now. So what are we going to do about looking at basis moving forward when, Western Canada, the way you calculate basis is using a print of what Random Lengths says Western Canada is, but moving forward, many other deliverables are in there. So what do you think?
So historically, and again, when we look at basis and show these basis charts, this is always a reflection of Western SPF 2x4s. But the reality is we've got hundreds of basis charts that look at anything species or item wise. So you can look at Doug fir, you can look at coastal hemp fir, inland hemp fir, you can look at southern yellow pine, western, eastern, central, you can look at Great Lakes, Boston, Toronto, run the full gamut of regions. And so when you look at basis from a future standpoint, you're just going to have to adjust whatever that freight is from FOB Prince George to Chicago. And historically, you're going to have to just say, all right, this is the leap of faith. We're going to add X amount and go back and add that historically to the numbers to kind of update these, to kind of reflect reality of what the basis charts are today versus the expectation of what that new contract delivered to Chicago means.
Right. I think it'll be fun. I think we need to start looking at what is the Great Lakes print versus the futures contract.
Yeah. But again, it's just going to be, the art versus the science of what do I think passes the smell test, and then adjusting accordingly, the historicals to kind of extrapolate out, what the reality of what these basis charts mean today versus what they'll mean a week from today.
Absolutely.
Yeah. So the next time we do this, Mike, we'll officially have kicked off, right, the new contract.
Yeah. One other thing I just want to kind of throw out there, there's a lot in the news about housing prices and outside of the United States. Like there's a massive correction going on in China right now.
Yeah.
Massive correction going on in New Zealand, which, is a small little, dot on the map compared to China. But it's important to understand lumber is used in mostly new construction, and new construction, it's a conversion factor. So I can sell this house for, X. Well, what are my input costs? And I don't see housing slowing down that much because I think input costs have come back enough to make sense for this housing market to stay. I'm not going to say strong, but not weak. How's that?
Yeah, no, and for me, globally, you're obviously going to reset those areas that had insane growth. Uh, Somebody like China, okay, they're slowing down dramatically, but kind of what's going on with Russia now, the reality is China is going to buy significantly more wood at discounted prices from somebody like Russia. So the export opportunity to Asia right now, especially going to China, is probably significantly less for BC mills. So I just, look, if you're trying to capture market share, then that's the scenario. You just run stuff into the ground, and you probably will see that to a point in BC where the bigs want to capture that market share relative to the intermediate and small sized mills. But I also think that the industry as a whole is going to be receptive. Well, if housing is showing signs of slowing down, or the returns aren't going to be as robust as they've been the last 2, 3, 4, 5 quarters, I think it becomes very fluid. The assumption is that you're going to run stuff into zero. I struggle with that for a simple reason, in that this industry has reinvented itself over the last 2 years. And what was, as far as the expectation of being a lumber sawmill, generating lumber sawmill returns, I think publicly traded companies, public shareholders have gotten conditioned now to the expectation of significantly higher returns, and it's going to be tough to just go back to the old way of doing things and just say, no, that's an anomaly, that's not us. I still think companies want to generate these bigger returns, and if housing truly is going to slow, then I think you're going to see. And again, I don't think it's necessarily it's not going to be global, but you're going to be more receptive to your EBITDA. And if I have a lower EBITDA, lower performing sawmill in this region, in this country, in this sector, you can be much more cognizant of that, and be willing to kind of put that up on the firing line and concentrate on those areas that have higher returns. So I just think, it's not a foregone conclusion that housing is just going to fall off a cliff. I think that's the expectation going into Q3 or Q4 at some point. But as much as I want to say that I see this massive slowing demand, um, in the U.S., boots on the ground suggest otherwise. That I don't see this build. And again, well, I know the other guys later this week will get much more into the details with physical cash. But personally, with the accounts, the people that I deal with, I don't see this build of inventory at the distribution level, at the end user level, where I see inventory still very thin. And I still see, okay, the expectation is, well, the sawmills are building inventory. That's probably the case, but I think it's a sawmill by sawmill look, and I still think rail issues and the ability to ship wood are still heavily influencing this market. And all that being said, I still think there are lower lows ahead of us. I'm just not convinced it's right now. I still think it's more of a seasonal thing. You get into October, November, that's the reality of when those lows are likely to take place.
Absolutely. I think that the seasonals tell you that as well.
Yeah, for sure. For sure.
All right. Thanks a lot, Greg. Welcome back. It's good to
Yeah,
have you
glad
back
to be
here.
back. I appreciate it.
And then we got the webinar this afternoon about the spread, how that's going to work. And we'll have some new numbers to talk about next week. Pretty exciting. New content.
Yeah, no, I can't wait. We're finally to the point where we've dreamed about this for a long time. The dream's coming to a reality, so that's awesome.
All right. Everyone, take care, and we'll see you in about a week.
All right, thanks a lot, Mike.
Bye-bye.
Take care.